Good morning. It's September 24, Friday, 5:43 a.m. Welcome to episode 19. Good morning to you, Wawi, and to our
Morning.
listeners. I hope everyone had a great week so far. This is your host, Mark Yu.
And Wawi Santos.
Welcome to the Mark Yu and Wawi show. A
Good
disclosure,
morning.
this show is made for information purposes only and not to be considered investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. The show's goal is to share and learn from each other, answer questions, and to our co-workers in the medical field, thank you all for your hard work. We are available on YouTube, Spotify, and Google Podcasts. On our previous episode, we discussed the basics in options trading with none other than Pradeep Rapali. How risky it is and how rewarding it can be and how devastating it could be for an inexperienced investor. In addition, we took a closer look at contrasting flow and sentiments in the stock market. For those who have missed it, please feel free to go back and listen to it. So, on our today's episode, we're going to tackle the weekly jobless claims. We're going to start with that. So, for weekly jobless claims, it totaled to 351,000, which was worse than expected. It's an increase of 16,000 from a week before, and it's over than the estimate of 320,000. Also, the continuing claims increased by 181,000 to 2.84 million. So a little bit not meeting expectations right there. Initial claims for the week ended in September 18th, which is last week, totaled 351, an upward from 335,000 and well ahead from a 320,000, which was the estimate. So in short, there are still a lot of people there with initial claims under unemployment insurance. Lots of people still out of work, and continuing claims is still at 2.84 mark. Well, looking at this chart though, as of in comparison to January, at least we have lost quite a good amount of unemployment insurance claims. Overall, it still didn't meet expectations, but it's almost down 50%. So people are heading back to work.
Yeah, according to CNBC,
Mhm.
there's still continuing claims of about 2.84 million
Yes,
jobless.
yes. And two states accounted for the biggest share of these continuing claims. It is from California, the state of California, and Virginia. All right. On to our next slide. So, believe it or not, we're almost done with September. Just 6 more days and we're done with September. And
Mhm.
supposedly, this is the month that we experience slump in the stock market. Earlier this week, we have felt quite a dip, quite a blow for those who are paying close attention. This is because of a Chinese entity called Evergrande, which we're going to tackle in a little bit. It's a giant real estate firm. It's the second largest in China, which is encountering some debt covenants, possibility filing for default, which is a very troublesome issue. So the markets got rocked, but it bounced back up, which we're gonna look into closer in the following slides. So it says here, quote unquote, from Michael Ranking, senior market strategist at New York Stock Exchange. He said, the global relief rally that began on Tuesday evening is continuing today. This is as of last night. He noted that Wednesday's Fed announcement offered no surprises. On the China Evergrande Group situation, investors are getting more comfortable about any contagion risks. Um, so nonetheless, in summary, like for this week, the Fed came out with their meeting, showing some signs of possible tapering, but nothing quite serious or unpredicted. That's why the market rallied. So finally, we're gonna take a closer look at China's Evergrande. So what's the Evergrande? This is a Wall Street Journal article that just was published this morning. What is China Evergrande and why is its crisis worrying markets? The Chinese property giant's debt load is teetering. Here's a look at the crisis and the risk of a collapse. So, what is China Evergrande and could it default? Evergrande is an enormous and heavily indebted private sector Chinese property developer and home builder that is close to defaulting on some of its billion of dollars in debt. The most urgent immediate deadline is September 23 when the company has an 83.5 million interest payment. This is just yesterday. So as of this morning, I was taking a look at the news. It seems that Evergrande is actually has stayed silent. It hasn't updated its investors, and a couple of bondholders, according to Bloomberg reports, reported that they haven't received a payment. So technically, they're already in default, but they're also looking for a 30-day grace period. So I don't know how that works, but technically, bondholders haven't had their money back, which is due today. Um, so it says in the Wall Street Journal article published this morning, investors were in the dark Thursday. So as I was saying, they haven't been updated actually. So in recap, this week, Evergrande actually had to pay its first debt covenant Tuesday this week, which hovered around $35 million, which it was able to meet. But this morning, they are supposed to pay around 84 million, but they haven't actually, they have stayed silent on this. So that's one thing to consider. It could it cause any further trepidation in the markets? Maybe, maybe not. We'll see. What is China's government doing to prevent a crisis? Chinese authorities are asking local governments to prepare to step in only at the last minute if Evergrande fails to manage its affairs in an orderly fashion. So there's a already a clear statement here from the Chinese authorities that they're kind of already expecting a default if
Yeah.
Evergrande Mhm. If Evergrande doesn't meet it, local governments are incentivized to come in and probably take over Evergrande and stabilize it. How big is Evergrande? Evergrande had nearly $78 billion in sales last year and hundreds of projects in more than 200 Chinese cities. For years, it used borrowed money and pre sold apartments to aggressively amass land and develop projects. So it's probably a real estate builder, construction
Mhm.
firm. Along the way, the company paid out billions in dollars in dividends to shareholders, including the equivalent of more than $5 billion over the past 3 years to its founder and top shareholder, Chairman Hui Ka-yan.
And to put that in perspective, the Chinese investment market,
Uh,
40% of Chinese household wealth is invested in the property market.
14%.
40, four
Oh,
zero.
40%. Oh,
Mhm.
wow. In
So it's
real
a big
estate.
chunk.
It is definitely a big
A
chunk.
lot of people are invested in the property market.
Right. Well, that's incredible at this point in time because they're already like what this article says. Evergrande is facing a crisis, and if it defaults, people who bought the property thinking it would be developed could be torn apart. They're financial. If Evergrande claims default, then these people, these customers that put their life savings, thinking that they would reap the rewards of living into a nice property later on in the years, won't come, and it's a devastating blow because they won't be able to get their money back. So why is Evergrande facing a crisis? Problems started to emerge last year, obviously during when pandemic lockdowns hurt property sales for months, and they snowballed into concerns about a cash crunch last fall. So they already started warning, I guess, their investors even as early as last year. Meanwhile, China's efforts to crack down on borrowing by real estate developers via limits known as the three red lines kept the company from taking on new debt. Cash is so short. The company this summer started paying some suppliers with unfinished apartments instead of money. That's a really troubling signs when even unfinished apartments are being used to pay. So how much do they owe? Company equivalent of around 88 billion in outstanding debt at the end of June. And 42% or nearly half of it would be due in less than a year. I think October 11th, which is my birthday,
Oh,
is the
happy.
i- is the critical day because by October 11th they're supposed to pay 190 or 186 million dollars in total. So that's just days away from today. So if they can't pay, if they have stayed silent overnight about yesterday's 80 something million-dollar payment, I don't know what's going to be like by October 11th when they are supposed to pay 180 something dollars. All in total.
Well,
Mhm.
well, happy birthday, Mark, advance.
Thank you.
Uh, it looks like, the saving grace is People's Bank of China,
Right.
injecting 270 billion or 42 yuan, equivalent to $42 billion this week.
Yes, they're trying to plug that hole, a big hole, by throwing in some money indirectly to the overall market. But yeah, all in all, Evergrande has sold an estimate 1.4 million apartments worth 200 billion that it hasn't yet complete. So will Evergrande hurt Chinese growth? Analysts think it could. Chinese home sales weakened over the summer with a drop of nearly 20%. This is a bear market already by value in August from a year early. Construction starts are down, and shares of other properties have already been hit. To head off further damage, the government faces the challenge of ensuring Evergrande customers get the homes they bought. So quite a worrisome picture right there in China. A
Yes.
very, yeah, a very contrasting view what we're experiencing here in the US, which people can't get enough homes.
Yeah.
So a
Well,
different contrasting view. Mhm.
well, the debt exposure, you know, is higher in China,
Uh-huh.
for Evergrande
Right.
than it is outside China. So the
Mhm.
biggest shock wave is in China.
Definitely. Hopefully, you know what they say, oh, yeah, if China sneezes, the world catches a cold. So
Yeah, we'll catch
hope,
a cold.
hopefully it will just be a buying phase, like a good opportunity to buy when global stock markets start going down because of this. But yeah, taking a closer look at China Evergrande. So I was referring to Evergrande. It looks like it's China Evergrande. It has China in front of it. So regardless, it's a 31 billion market cap at this point in time, according to Yahoo Finance. If you're gonna look at this stock, it's quite devastating. It was hovering around $20 a share back in October 5th last year. Now it's like lost almost 80-90% of its value. $2, $2 and 36 Hong Kong dollars. And it's down 12%, nearly 12% overnight because of them staying mum on their payments. So this is what's more important. It's financial numbers, which we always take a closer look at before we even consider buying its stock. So 2019, they registered 478 billion Chinese yuan revenue. And believe it or not, even during the lockdown um, of last year, they grew their sales to 507, almost about 30 billion Chinese yuan. So they grew even during the lockdown. So let's take a look at their profits. So we haven't taken a look at this number before this recording. So we're looking at this together. The profits for 2019 normalized income is 17.3 billion Chinese yuan. 2020, well, that's quite a drop. 15 billion drop to 5.55 billion Chinese yuan. So they lost quite a good amount there. So despite increasing their sales during the lockdown, they definitely lost a lot of money in their profits. But they still nonetheless recorded a profit of 5.55 billion. So obviously the company is making money. I mean, even those companies here in the US like Uber, or Lyft, nothing in comparison in terms of business model, but Uber or Lyft, for example, didn't even register profits. Evergrande, otherwise, on the other hand, registered profits. So not a troublesome sign there. 2019, let's look at the cash. I don't see the cash.
5.55 billion is roughly about 0.86 billion US dollar.
0.86. That's not bad. Almost a billion. Yeah.
Mm-hmm.
So if we're gonna take at the assets, oh, here we go. Cash. 2019. Evergrande had 150.151 million. This is thousands, million. Yeah, 151 million Chinese yuan. And it increased even more to 162 million Chinese yuan in 2020. And for their debt, this is what usually is a troublesome sign. But in their case, it looks like it's very manageable. Look at that. 151 million, 800 million in 2019. It even went down to 719 million in 2020. So not as quite of a huge uh like worrisome signs back then. Even the 2019 of their cash flow, let's see, free cash flow 2019, the free cash outflow of 82.5 million. They generated positive cash flow at 92 million. So not as quite as troublesome image here, which is quite interesting. This definitely quite taken investors for a surprise. That's why we're seeing these kind of like shockwaves being felt in the stock market. Well, not as troublesome, I would say, Kuya Wawi. If I would see this company and it's trading like half a book value, I would look at it and think like, well, in terms of the numbers, it would attract me as a valuation, deep value, because it's look at the price to book, it's like 0.2,
Mm-hmm.
20% of its book.
So, how did they defaulted? What happened there?
So I think it all boils down to what just happened on September 13th when news from South China Morning Post, the video emerged when, so not suddenly, it probably has already, snowballed into this event where mom and pop people like residents or investors signed up for Evergandy, put their hard-earned money and hoping that they're gonna have a real estate, something new, elegant
Mm-hmm.
to live in, but they haven't delivered to those properties yet. These news reports or videos of wild protests, or not wild, but mass protests on Evergrande
Mm-hmm.
headquarters surfaced, and eventually, people started looking closer to Evergrande since that point in time, September 13th. Right now, it's just September 24th. Just been 10 days. And
Mm-hmm.
people started looking, analysts started looking, Wall Street starts looking, and looks like Evergrande is really having a hard time collecting their money and to pay their debt. They're actually using either their unfinished apartments to pay their suppliers. So that's a troublesome sign. So without further ado, we're going to take a closer look at a Bloomberg interview here, or analysts talking about Evergrande. It's entitled China Tells Evergrande to Avoid Bond Default. This was published just yesterday, red hot from Newsline's 25,000 views. Let's roll the clip.
Steve, what do we know? Well, we know that that deadline came and passed, but again, there is a 30-day grace period to pay the coupon on that dollar bond of 85 million US dollars. Of course, is emblematic of the woes that has been inflicting China's most indebted developer with more than $300 billion in liabilities. Of course, we are hearing from sources that the regulators, financial regulators in China, have instructed Evergrande to make sure that they avoid a near-term default on that dollar bond. If you remember, a couple of days ago, we did get a statement from Evergrande that they had already resolved through negotiation directly with the bondholders on that yuan bond that was also due yesterday. No details, though, on how much of that interest was paid and on what time frame. But the big question yesterday, of course, and going into today is was the coupon paid on that big $84 million bond. Well, Bloomberg News has contacted two bondholders who remain anonymous, and as of 5 p.m. Hong Kong yesterday, they said they had not been paid yet. But regulators urging to avoid a default. They have that 30-day grace period, but at the same time, they're also urging Evergrande to make sure that two things happen. Complete the properties that are still yet to be completed. That way you can, fulfill some of your obligations and get cash flow coming in. But that has a trickle-down effect as well. You have to pay your suppliers and pay your contractors. You have to have the money to do so. That's complicated. But also you need to pay back investors who have put billions into your wealth management products.
Yeah, and given that you don't have enough money, how's that affecting the operations of its units?
Absolutely is affecting all areas of the I guess you could say probably shrinking empire. But we did hear one note I want to say on the bond payment. We did hear from Dow Jones Newswire is that they're reporting that authorities have said that told authorities in Guangdong as well as some regulators there to only step in at the last minute should Evergrande fail to manage its affairs in an orderly fashion. Now, on the other units, of course, Evergrande has been trying to sell off non-core assets, including its new energy vehicle group, the EV electric cars. They have a big mass delivery schedule for next year, but they're having the cash crunch, and sources are telling us they have not paid some of their employees recently, and they have not paid suppliers. That puts their mass delivery schedule for next year in serious doubt.
Oh, not a good sign. I think you're on mute, Wally.
Yeah. Well, Bank of China to the rescue.
I know, but the thing is, it's gonna be only in the last minute. So let's take another listen to this other discussion about Evergrande by CNBC. This was also just published last night. 9,500 views, entitled "Evergrande is not China's Lehman Moment," according to Rosenberg. Let's roll the clip.
So stocks are holding on to big gains on hopes Evergrande's debt prices can be contained in China. Investors are also digesting Fed's move yesterday, like Bob was discussing, the signs of movement in DC towards an agreement on a big spending bill. But is it really clear sailing from here? The Wall Street Journal this morning reporting Chinese authorities are asking local governments to prepare for a possible storm, indicating their reluctance to further bail out Evergrande. My next guest says this is what will shape global economies and markets. Joining me now is David Rosenberg. He's president, chief economist, and strategist at Rosenberg Research. David, it's great to have you here. Could you just first offer some observations about this rally that's shaping up over the past, I guess you could say near 24 hours going back to the Fed, but maybe it's even before that going back
There's lots
to
of books.
What looks like the Chinese dealing with the Evergrande issue.
Its bookshelf is full.
Right. Well, I don't think that you could really look at the stock market's movement in the past couple of days without looking at it in the context of what happened earlier this week. It's clear to me that the vast majority of this rally is a relief rally. It is based on regressing the early week concern that Evergrande was going to be a Lehman moment. I mean, you know as well as I do, almost everybody that came on CNBC that day was addressing whether this was going to be a Lehman moment. And we know now that it is not going to be a Lehman moment. There's a greater understanding as to that this is all domestic debt. The amount of foreign held debt is very low. And I think there's just more confidence now, and it could be tentative, but there's confidence now that Beijing is going to step in and smooth this demise, or maybe even nationalize Evergrande. So the market's just done, what can you say? It's just been a roller coaster ride.
Right.
But to me, this is largely based on Evergrande today.
And you're saying it's a relief rally about the direct knock-on effects, but do you still think it's an issue? You know, when I look at what you've been writing about, you're sort of warning people that it will slow China's economy. That is going to have kind of an indirect effect on growth. So what does that mean for stocks, and what does it mean for bond yields, which, you know, like Rick was saying, their move has been possibly even more dramatic here?
Yeah, well, look, the reality here is that even before Evergrande was making the front pages of the morning papers, the Chinese economy was slowing down precipitously. I mean, between April and August, retail sales in China are down 20% at an annual rate. Yeah, that's -20. Industrial production is -8%. Property sales, even before this fiasco, were down 20%. I actually think that there's a very good chance that China is double dipping. What's the net impact on the U.S. economy? It's not that big because the U.S. economy is a large, basically closed economy. And as big as exports might be to China as a share of the economy, it's very small. So the direct impacts aren't that big. And we saw that, look, when we had the Asian crisis, which began really in July 1997, I'm old enough to remember that, it didn't become a big problem until long-term capital about, a little over a year later. It never had a direct impact on the economy, had an impact ultimately on the financial markets. So the point I'm making here is the knock-on effect, when thinking about where China is really important from a macro standpoint, it consumes half of the world's basic materials. So to me, this is a big question mark over the big reflation commodity trade.
Sure.
I think a Chinese big slowdown recession is going to unwind that. And so that's where I think the big impact is going to be.
Interesting. It looks like this guy has a really good point. Not on the latter part of the interview for sure, because
He's thinking we're relatively insulated from the China Evergrande event.
Some sort of like that, because like you said, China consumes half of the world's materials for production. It's a one big giant factory that they export stuff to the Western nations for consumption. So if anything, first of all, the Chinese government won't let it sink. They want the local governments to step in the last minute before it actually collapses. But the thing is, hopefully, they don't wait. Officials should try not to wait and be a little bit proactive. What if, something is really messed up inside and they can no longer help themselves? Like right now, they're staying silent in terms of their bond payments. But yeah, regardless. So if China slows down because of this, is already been slowing down actually. Like last month, I remember while we pointed out, U.S. economy is being resilient right now because of the stimulus checks. But the Chinese government, the country is China, its manufacturing and its purchasing has slowed down, and Europe as well has slowly, reduced its growth rates or changes in their manufacturing. So if China slows down and it's further impacted by this, hopefully his point of us being insulated will stand. But mostly he said that the economies that will be impacted for sure are the countries that heavily rely on exporting their goods to China, which are Canada and Australia. Australia, of course, for their coal and iron ore. Canada, probably, I'm not sure. Probably oil as well. No, not oil for sure, because they do Canadians. They do oil sands. More likely they're potash, which is some sort of a material for fertilizers. Well, what do you think, Maui? Hopefully it doesn't go as bad.
Well, after you said that, then you're also looking at the beef exporters, the agricultural exporters, like soybeans. They get a lot of soybeans from us.
Oh yeah. I remember Trump trying to ban soybeans export before, during the escalation of the trade war before COVID. But yeah, so looks
so
like
we will be affected for sure. Hopefully, and that's the key word, right? Because we don't know the magnitude of our involvement in that and the ripple effect of that. What I'm seeing is, Europe, their housing prices are also increasing before summer of this year, and I don't know how much of that would, how much of their stock market is going to be affected by this as well.
Yes.
So it's the ripple effect that we're gonna, I think, have to watch for. How each of these individual country stock markets will respond to whatever comes out of this Evergrande event.
Yes, and we always have J Powell as well, so we'll see what he does. in terms of calamity. So
yeah, now his words are more powerful.
oh yeah, for sure. And futures indicate that we're gonna be having a down opening. So Dow futures down 90 points, Nasdaq down 73 points. Not sure if this is directly related to Evergrande, but this was the case back in Monday when all these bad news are starting to pop up over the weekend. So here, the federal minutes. So this was just published yesterday or the other day after Federal Reserve convened its monthly meeting. So entitled here in the Financial Times article, more Federal Reserve officials see first interest rate rise in 2022. Chairman Jay Powell says U.S. Central Bank could easily move ahead with taper announcement in November. So a growing number of Federal Reserve officials expect an interest rate increase next year as the U.S. Central Bank charges ahead with a reduction of its massive stimulus program that will probably be announced in November. 9 officials of the FOMC or Federal Open Market Committee now expect a U.S. rate increase next year, according to projections released on Wednesday, with the remaining 9 penciling in a later liftoff. So in comparison, in June, just 7 officials were forecasting a rise in 2022. According to Jerome Powell, my quote unquote, my own view is that the substantial further progress test is all but met, referring to the central bank's employment goal. Powell added that the Fed could easily move ahead with an announcement of the taper at its next meeting in November if the economy progresses as the central bank expects. So it's coming pretty soon. The rate hike, they're definitely signaling a more hawkish tone. Hawkish meaning that they're going to try to raise the interest rates or being in intention of raising interest rates. Bob Michel, Chief Investment Officer at JP Morgan Asset Management, said, quote unquote, the economy is on the road to recovery. Given the inflationary pressures that are there and the concerns of the committee members, it's time to start the normalization process, and it begins with tapering. So looks like the central bank, more and more members are being hawkish, trying to signal an interest rate hike pretty soon. So for what is its relevance to investors? So it means that interest rate rise would increase overall bond rise, yield rates. So there could be more. Taking in more debt would require higher interest payments later on. So this might tamper down the economy, kind of slow it down a little bit because it's like red hot at this point of time. Just look at indirectly affecting house prices, the stock market prices, valuations over the roof, highest ever on record. So this would kind of put some, tampering down in the valuations. So here's an article from CNBC. Says, here's what will happen when the Fed's tapering starts and why you should care. While the Fed has gone into policy retreat before, it has never had to pull back from such a dramatically accommodative position. For most of the past year and a half, it has been buying at least 120 billion of bonds each month, providing unprecedented support to financial markets. And the economy now will start to walk back. So the bond purchases have added more than $4 trillion to Fed's balance sheet, which now stands at $8.5 trillion. In a little bit, I'll show you a graph where it kind of like reflects the Fed balance sheet and the overall stock market. So yeah, not to hide any surprises, but it definitely looks like it's relatively proportional. Like as the Fed balance sheet increased, the stock market has increased as well. So there is some correlation there, and this is what kind of is spooking the markets. And what the thing is right now, analysts are saying that the market is quite already expecting it. So hopefully, Fed takes it nice and easy, and the stock market just reacts, flattish or steadily to this increasing of interest rates. Charles Schwab, head of fixed income, Kathy Jones said, quote unquote, it's certainly been communicated well. So I don't think that should be a shock to anybody or cause a disruption to the market. The question really is more around asset prices than interest rates. We have very high valuations across the board in asset prices. What does this shift away from very easy money to do to asset prices? So we'll definitely have to sit and watch what's going to happen as a result. So what do you think the immediate market reaction, Wally, once they start raising interest rates?
Well, it should correct the value of the company share prices,
Right.
generally. So we should see some correction there. But the forecast for GDP is favorable. They're expecting the U.S. GDP to rise 1.5 to 2% in the second half of next year.
Okay.
So it would be slow.
A little slow, yeah.
Forecasts for U.S. exports are also favorable according to Forbes 3 days ago. So it should be a slow pace, but they're seeing that the key factors will be the COVID-19 pandemic,
Right.
and how our trading partners vis-a-vis China
Right.
fares economically.
I know.
So
Uh-huh.
we're still tied to China, like you said, as far as export. So hopefully China can get over this crisis situation.
I know. And hopefully, we don't know yet, but I know for sure BlackRock, one of the largest fund managers with $9 trillion in assets, is quite exposed to Evergrande. It has about 300, 400 million exposure. So I'm not sure where or who specifically are these, the regular mom and pop 401k investors who are invested in Evergrande, or who else. But if Evergrande collapses, for sure it'll make a dent to the overall stock market. So we'll see how it goes. But one thing's for sure, you have to stay, liquid and stay solid to your investments. So this is an article from Bloomberg, which was published last night or yesterday, entitled Household Net Worth in US Hits Record on Surging Home Values. So take note, it's home values. It's not the stock market alone, but home values kind of predict your household net worth as well. So as the net worth, as the value of real estate held by households increase, the value of household net worth also increased. So we're now at 1.4 trillion US dollars in net worth, highest ever in history, which also reflects the highest ever value of real estate at 388 trillion. Oh, no, 388 billion dollars in terms of net worth in household. So the higher it goes, the better it is for U.S. Residents who own a house, at least. It's very important to consider as well. It says here on this article, but not everyone is benefiting from those wealth gains. A large share of Americans are not invested in the stock market. And for many renters, the sharp rise in housing prices push the reality of owning a home further out of reach. So
there's definitely that gap. So this type of education is important, to reach out to people, so they'll invest their hard-earned money on companies that they believe in.
Right. Getting exposure to real estate as well as in the stock market is definitely a path to enrich your assets and your wealth. So yeah, just stay on and buy the dip. The joke. So here in the buy the dip segment, we're now going to take a closer look at the flow and sentiments. So this is just last week. Evergrande's headlines start rocking the markets last weekend. And on Monday, stock market indices here in the US took a dive. Dow Jones itself lost 614 points on Monday. But if you stay put and actually bought the dip, you would be reaping some good rewards, because overall, as of yesterday, the market recovered at least 840 something points from the Monday's dip of 600 points. So you actually gained a little bit more as of Thursday if you bought the dip, or if you stayed put as of Monday until yesterday, you have gained some gains in your portfolio. So now we're looking at the flows and sentiments. Flows and sentiments for the week brought to you by Bank of America. Interestingly, we have experienced the first outflow in global equities. This dip right here just happened this week. This had occurred since the first time it occurred since January of this year. So more likely there are people who have dumped their shares Monday. Quite a huge amount. Somewhere around 30 billion looks like, who dumped their shares on the Monday's panic in terms of the Evergandy sell-off. So this is what I was referring to. The Federal Bank or Reserve, as they were handing out QE, the market cap of Apple, Amazon, Facebook, Google, Microsoft, Netflix, and Tesla had also increased almost at the same path as the central bank liquidity has been ongoing, the bond buying. So definitely a relative proportion there.
And that's what we should expect, correct? We
Yes.
should expect a correlation.
Yes. So once this kind of like tightens, if the liquidity, if the bond buying has slowed down, we would probably see some slowdown as well here. But if you're going to take a closer look, if they slowed down back in 2018 to early 2020 before the lockdown, the value of these large cap companies has stayed flat. So not much action. They didn't actually drop, but not much. Okay. So they did kind of dip a little bit, but eventually bounced back up even before the bond buying program started during the lockdown. So the fund flows. So let's see where the fund flows are going. Looks like it's going still to the Treasury inflated protection securities. So if inflation sensitive securities are receiving more funds again as of last week or 4-week cumulatively flows for the past month. Japan, high yield, municipals, bank loans, utilities, these sound like conservative investments. And fund outflows are coming out of growth, MLP, energy, low volume, precious metals. So the fund flows are coming out of growth or tech. They're coming out of reopening plays such as energy. And they're going into more conservative segments of the market. But in contrast, energy has been outperforming.
From the surge of demand and the increase in oil prices.
Right. So oil price definitely has climbed up recently because of the low stockpiles, even with Saudi Arabia pumping out oil. So for this week alone, energy is the best performing sector, believe it or not. Financials ranks in second, but not that much, 0.39%. And the rest looks like they've suffered some type of drawdown. Utilities are down, which a lot of monies are piling into. We just saw on the slide, people are buying utilities, but for the past month, but they have underperformed. For the past 3 months, technology outperforming the rest, energy underperforming the rest. So if you look at it at a longer term basis, energy is slumping a little bit, but this is the most important chart. Year to date. So since start of the year, energy is the best performing asset, followed by communication services, which are the heavy, like the high tech companies. Communication services includes Google. I would say also Netflix, and followed by some other like Facebook as well on this segment, which is like very cash rich companies. Financials, if you held on to them since the start of the year, you should be gaining somewhere around 20%, which is not bad. And despite the slump that we experienced early on this week, since you're still in the green if you've held on to your investments since the start of the year, nonetheless. So, American Association of Individual Investors. So, we take a closer look at this every week, monitor the bullishness and bearishness of the investors. So, what direction do members feel the stock market will be in the next 6 months? As of couple of days ago, there was an increase in slight bullishness from 22% last week. We're at almost 30%. So, bullishness is going back. But at least the bearishness of people are still maintained solidly at 39%. So we're still at that kind of like 50-50 mark right there. Fear and greed index. What emotion is driving the market right now? It's fear. As of this time, it's fear, 31. Whereas a week ago, it's still fear, but a little higher. A little bullish at 39. So we dropped a little bit more bearish at this point in time in comparison to American Association of Individual Investors. So overall, we're still hovering at the fear territory. And then Bitcoin, we're at 33. A little bit of down dip from last week's neutral position of 48. We're down at 33. And volatility for the past 5 days is up 5% to below 20 points, 19.80. For the past month, it's up 15%. So volatility has definitely increased because of trepidations in the market. And overall, in the long term, it's still hovering. It's slightly increased already, but it's still hovering within the certain average of 25-15 range. So this is the dip that we just saw. So a great dip in Monday, buying opportunity in hindsight. And now it's back even more higher, except for NASDAQ, looks like. NASDAQ is still negative 0.9% as of this morning. And for
how about the Russell 2000? Let's see. How is that doing?
Russell 2000, let's see. I think Russell 2000 are composed of the 2000 small cap index, right? Small cap.
Yes. The small caps.
For the past 5 days.
Relatively unchanged.
Unchanged. Yeah, for the past 5 days, it's negative 0.61%. So a little close to the break-even point from last Friday, but it doesn't show the data for year to date. But yeah, it sort of bounced back up. So relatively, what I'm trying to point out here is I think it's better to just stay put in the market. Just stay diversified and not fear, at least, and be ready to buy the dips. So
so there's a rotation. So we're seeing a rotation. So some people are putting their money on energy and financials.
Energy and financials, they're putting some money into it. And for some reason, I see this always like the tips, people buying treasury inflated protection securities. So me personally, I don't have exposure to that. Maybe it's for the wealthier clients who have access to it, or you can just select that as a ETF. Probably it has an ETF. Let's see. So people who buy this kind of like securities are trying to hedge themselves from eventually rise in inflation. So there is such. It has a dividend of 3.8% per year. iShares Tips Bonds. It also has Schwab, ticker SHIP, SHP. So definitely there are products, but I'm not personally not interested in buying tips at this point in time. How about you, Bowie? Are you interested in buying some tips?
I looked at it, but the returns were not attractive enough for me.
Yeah.
Looking at the ETF.
Yeah.
So I'm still invested in the stock market mostly.
Likewise. So now we're going to roll the clip, a bullish and bearish sentiment contrast, which we're just, recorded yesterday. So this is an interview in Bloomberg as of yesterday with 4,500 views entitled "Investors Need to Be Ready to Act on Market Pullback," says Raymond James. Let's roll the clip.
Still with us, Larry Adams, CIO for Raymond James Private Client Group. And Larry, we talked about the reflationary trade underway within the equity markets. Take a look at the bond markets as well. I mean, it is 11, 12 basis points on the day if you're going out long term. Is that a healthy sign of higher inflation and higher growth that we are now finally starting to price in?
Absolutely. I think that that's just a reflection that we're looking for good economic growth, as we were talking about earlier. I think one of the misconceptions out there that a lot of people have is that when interest rates go higher, that's going to end the bull market. Historically, that is not the case, because as long as the economy is going well, that should be very supportive of earnings growth. And I think that's the environment that we're in, particularly for those cyclical sectors.
Okay, interestingly, so the cyclical sectors have been getting a bit of late. Finally, certainly oil companies, energy companies leading the charge higher. But when we start to see PMIs rolling over just a little bit, as we did earlier today, and we are worried about perhaps the labor issues that seem to be coming up in the earnings statements, at least, and supply chain constraints, are you worried about the economic growth? Are you worried about the cyclical pay?
No, I think that all this is temporary. I think we're at the cusp of seeing everything turn around. I think as you look out, for example, over the next quarter, I think consumer spending is going to be very strong. We just had record back to school spending. I think you're going to see record holiday shopping in this upcoming season. So I think that'll be supportive. Don't forget that companies have pretty much nil when it comes to their inventories. You're going to see a massive rebuilding. And I think when that starts to happen, that's going to help them to actually maximize their sales going forward. And that'll help our earnings as well. So I'm not overly concerned about this interim period of softness. I think it's going to be more sustainable as we get through this COVID, as we go forward.
With regards to just the general trajectory of equities, at least as far as measured by the broad indexes, there's been a lot of talk, Larry, about the idea that we haven't had a meaningful pullback in this market. I think we had something like a 4% drawdown in the past couple of weeks from that all-time high, a setback at the beginning of this month, but that still didn't come anywhere close to official correction territory. Do you anticipate at all that the market needs to do that we need to see a big pullback of 5 or 10% in order to sort of reload and move this market higher, or can it keep drifting the way it's been going?
No, I think if you just look right now, this is the second longest period of time that we've had without a 5% pullback. So if you rely on history, I think we're due for a pullback. But as we've always said, pullbacks just don't happen so you and I can get in at a better price, right? So I think as investors, you need to be prepared to act when, in fact, that does happen. And if you get a pullback of 5 to 10%, just remember that historically, you recoup those losses in about a 2-month period. If you get one that's between 10 and 20%, it's usually about a 4-month period of time. So they happen very quickly, and you got to be ready to act. And that's what we've been telling investors to be. Just be prepared to respond if, in fact, we do get that type of softness.
And responding in the equity market, because Larry, I want to show a chart of real yields, and unfortunately they're still negative, at least on the 10-year, but it's getting less negative. We're now the least negative, I guess you could say, going back to July. Remains chuckling at me because it is a brutal chart, but could you say that financial conditions are still easy? I mean, what are these sort of negative 90 basis point on the 10-year real yields telling you?
Yeah, I still think it's very easy money out there. As you mentioned, the financial conditions have been above where they were pre-pandemic for 5 consecutive months. That just tells you how easy economic conditions have been. And I think that's why it's been very warranted for the Fed to cut back on their bond purchases. I think it's important to recognize that they had 4 goals that they wanted to accomplish, right? It was narrow spreads, increase confidence, reduce volatility, and increase asset prices. And if you look at all 4 of those goals, check, 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 they've accomplished all of them. So I think it was time for them to pull off some of that uber accommodative policy. And I'm not worried that you're seeing just a minor blip in being less negative from a real rate perspective.
Larry, how are your clients sort of buying your optimism? Are they going out there and thinking the only way is up? It's any cash that I had on the sidelines, I can see earning nothing, I need to put it in equities?
Yeah, so for the most part, we always talk about if we do get this type of volatility, the most important thing is not to overreact. Like Monday, one of the things that was very important, you don't want to overreact and have panic selling, because that can really damage your performance longer term. But if you see this volatility, we talk about maintaining your equity exposure. But if you do have cash, as you just mentioned, that's a time period that you probably want to put it to work. And we've seen a lot of that money go into work because right now, as you've mentioned, after inflation, after taxes, you're not getting much keeping it in cash right now. So I think we continue to put it to work.
All right. Do you worry at all, Larry, at all about some of the stuff coming out of Washington, whether it's the additional fiscal spending, whether it's the potential for higher taxes? Any of that give you any sort of worry?
So again, historically, this is a lot of myths that are out there. I call them misplaced myths. And people worry that if you get increased taxes, it's going to be the end of the bull market. Again, historically, if you do the homework, that has not been the case. Now that's done with the caveat that the economy remains strong, which we do believe that it will be. As far as the fiscal stimulus, I think it's, you're fighting two things here. Number one, is it lower in the size, which means we have less tax increases, or is it higher in the stimulus and then we get slightly higher taxes? I think that that's a wash for the market. I think if there is any type of upside risk, it's that we get a lot of this spending with very minuscule tax increases and they decide to go down the route of just deficit financing. That would be more of a near-term catalyst to upside for the equity markets.
Wow. I think, if anything, that's the most important interview of this week that I've been watching. That's crazy right there. You see how firm he is in terms of like, just basically it sums it up to just buy the dip.
Yeah, but he missed a benchmark there for the Fed, which is the jobs, to increase the jobs. That's one of the goals of the Fed, doing
Right.
their QE.
Mm-hmm.
That's one missing benchmark there.
Yeah, I like how he said, like, well, going back to the market performance, the market's not going to pull back 5 to 10% just to allow you to make you buy and wait for you to buy in that dip. You have to be prepared. And another statement that I really like what he said, like, market pullbacks happen, but eventually the market recovers. So he said a pullback of between 5 or 10% would eventually recover in 2 months time frame. A pullback of 10 to 20% will eventually recover in 2 to 4 months time frame. So as long as the economy is churning, it doesn't mean that the Fed's tapering that the market's going to crash. So it's still going to go up, or at least be steadily rewarding its investors. So yeah, definitely an insightful interview. I would like to hear again that clip. I'm going to play our podcast again after this. I'm going to listen to that guy because, man.
With regards to those rebound effect, after a fall, you would expect that more in your value type companies versus your growth companies. You should see the rebound of 2 months if it's a fall of 1 to 5%.
Yeah, I'm not sure. I think he's focusing more on like generally like the index itself. I think like S&P 500 or
Yeah, I know, but I'm referring to if you're looking at the growth companies, if you're highly invested in growth companies, you may not see that that rebound.
The bounce.
May be the bounce may be longer for growth companies.
Gotcha. Yep. So that's a bullish statement. So we're gonna listen to a bearish stance. So this was played a couple of days earlier. So this is entitled "Why Morgan Stanley's Wilson Sees Growing Risk of 20% S&P 500 Fall." It's almost garnered 25,000 views. Let's roll the clip.
Why the call for a correction that you've had for quite a while now? Why do you think that's the right place to be?
Yeah, thanks, John. I mean, look, patience is a virtue, I guess. I'm not sure I have patience, but this is not a new call for us, as you know. The mid-cycle transition has really been playing out since March. It's happened at the stock and the sector level almost perfectly. And then it usually ends with the high quality index finally taking its turn. And it's time now, right? So we've been patiently waiting, and we always felt like, we got to get to when the Fed gets to remove, maximum accommodation. That's always part of the mid-cycle transition, whether it's 94, 04, and 2011. Now we're there. It's this week. And by the way, that doesn't mean it's the end of the world. I mean, I want to remind people, the fact that the Fed's removing maximum accommodation is a good outcome. That means that the recovery has, happened and we're moving in the right direction. But it comes with consequences for financial assets. And, the economy is not the market, as you know. Last year, the markets were spectacular. The economy was not. This year, the economy is spectacular and markets have been more difficult at the stock and sector level. And ultimately, that ends with a correction in the major averages. Now, the reason we kind of stepped on the gas a little bit today with our note is because we actually see that the amplitude of this cycle, whether it's the downturn itself or the recovery, the V-shaped recovery, it's been extraordinary. It's been bigger and bigger amplitude than normal, which would suggest that the mid-cycle transition should also be bigger than normal, meaning the deceleration will be greater than what is typical. And that would be the ICE scenario where the revisions actually are quite negative for a couple of the quarters, and that may embody a bigger correction.
Is there something in the price action that has given you the encouragement, Mike, to lean more towards the so-called ICE scenario?
Yeah, well, John, you and I know each other pretty well. You're spot on as usual. Friday we finally got that crack on the 50-day moving average. It is everybody's been so focused on, and as you know, I mean, we are very disciplined around what the market is telling us, and so we felt like it was gonna crack overnight. It did, and look, price is probably one of the single most important determinants of people's behavior, right? All of these things that people are talking about today are known, right? Whether it's a situation with Evergrande, whether it's a situation with deceleration and growth we've been talking about for 6 months, whether it's the fact that Fed's going to be moving away from maximum accommodation. These are known facts, but the price was ignoring them and people were ignoring them. And now with the price breaking, that gets people to pay attention to the facts that were in front of the whole time.
We've got to work through this then. You're looking potentially for something that looks more like a 20% drawdown. You're leaning in that direction, Mike. I wouldn't call it your base case just yet. You can if you want. I'm trying to understand from your perspective then how you'd guide people through the drawdown as it develops. Many people have been told if there's a dip, buy it. I want you to help our audience distinguish between a dip worth buying and a dip worth avoiding.
Yeah, well, I think ultimately it's a recovery, and I don't think we're going to have necessarily double dip recession, but it may feel like that in the short term. So I would say the recommendation we're giving our clients, we did the same thing with our clients last week, is look, be patient with this particular dip. Right, the dip has been to buy every time at the 50-day, but we took that out now. So now you have to change your behavior. You have to say, I'm not going to be buying the first dip. Let's take a little time. And so for me, from a timeline standpoint, corrections are always about price and time. And so from a price standpoint, I think it's 10 to 20% great. But time, I think you've got to get through the third quarter earnings season. Let's see how the revision breath kind of plays through that. Let's see how the market digests the Fed moving towards tapering by year end. So to me, it's sort of 2 to 3 months. I think you've got to be patient in here. Let's see how this goes into basically the fourth quarter.
Is it too early to make a call on where the leadership comes from next, Mike? Do you have to watch this play out before you make that call?
No, we've made that call already, John, as you know. And we pivoted towards quality back in March, and then we pivoted further this summer towards defensive quality. We upgraded even utilities. We're overweight staples and healthcare. Those are our favorite 2 defensive areas. And I think that's the place to be right now. I think you want to be kind of defensively oriented, defensive quality, and then you've got to have other stocks in your portfolio too. You can't just own that, but that's where we'd be overweight.
Well, allow me to rephrase the question. What I mean, Mike, is when you come out the other side of this drawdown, a lot of people are already making the call on what the leadership will look like through the rest of the cycle. Do you think it's premature? Do you have to watch the drawdown completely materialize before you make the leadership call for what comes next?
Yeah, I think I now understand your question. I think absolutely the market will show its hand, and we're big believers in relative strength. So we will see where the relative strength comes from in this drawdown, and then we will probably skew our portfolios in that direction. My instinct tells me that this is a reflationary cycle. So we do think you'll probably want to have definitely some of these reflationary stocks and then cyclical stocks in that next phase. People, I think we got premature and started buying that, 2 or 3 weeks ago. We avoided that, but I think that's going to be definitely one part of the barbell. The other part of the barbell is going to be growth stocks. It's just you can't overpay for them, right? And so a proper drawdown may make some of those growth stocks attractive again.
So, Mike, you're leaning in this direction. Final question for me: what would make it the base case? What would you need to see to make it the base case? Cool.
Well, I think it's going to be a function of the fundamentals. So, our real call here is that we think earnings revision breath is going to flatten out and even turn down sharply. So if we start to hear that and see that in the data over the next 2 weeks, it's kind of a foregone conclusion. Now, we showed in our notes this morning, John, consumer confidence has already rolled over sharply. We think just mathematically the PMIs will head back towards 50 by year end.
Yeah.
Okay, that's normal in any mid cycle. And those are already suggesting that you should get a 20% drawdown. So that's why we wrote the note this morning. I mean, like, there's already plenty of indicators that suggest that's where we're going. And then, so the icing on the cake for me will be if earnings revision breath come down. But I want to make it perfectly clear, right? This is normal. This is what should happen. It's just more extreme, like this whole cycle has been.
So, Mike, final question. Allow me to squeeze this one in. How would you know if you're wrong? What would be the tell?
Boom. How would you know if you're wrong?
Oh, well, I mean, clearly price action, if we somehow, reverse here quickly after a 5% drawdown and we get back to the 50-day, and then all of a sudden, maybe the Fed doesn't move forward this week and actually says, we're gonna pause on this. We see another fiscal stimulus bill from the government that's really directed right at, kind of the consumer again, checks going out, and then maybe China, same thing, they do a big fiscal stim. Those are potential variables that we would absolutely have to take into an account, and it would change our forecast on revision breadth and PMIs and all of that.
Wow, quite really direct questions there to Morgan Stanley's Mike Wilson. For those who don't know, Mike Wilson is a really renowned analyst in Morgan Stanley. Whatever he says, usually he hits the mark. So him saying that there's going to be a 20% pullback, I mean, that's grabbing headlines. People are kind of worried that it's going to happen. And he already pointed out, which we already saw, Wowie, like earlier this month, we were already seeing consumer confidence going down, like diverging, negative compared to the stock market going up. So he's already pointing that out, and it's possible that, stock market is just going to be reacting negatively in the coming future. So quite a bullish stance, quite a bearish stance. So it's kind of hard to decipher, hard to make conclusions. You don't want to be timing the market at this point in time for sure. If you cannot sleep at night with your portfolio being as it is in positioning, you think you're way too much in tech, way too much in banks, or way too much in oil. If you cannot sleep at night and you think the market's going to fall tomorrow because of the Evergrande or whatever the reason that is, you might need to start chipping down your exposure. But on the other hand, if you feel like, yeah, whatever, I can stomach whatever happens. If the market drops by 20%, if you see your portfolio drops by 50% and you can still buy more, then I think you're in it for the long run and you can benefit from the rewards the market could bring, regardless of what happens in between.
Absolutely. Yeah, you have to look at your risk tolerance and how you're gonna allocate your assets at this point. If you have a low risk tolerance, then you can rebalance if you want to.
Yeah, maybe
but look at your risk. Yeah.
Yeah, for sure. So yeah, overall, if you feel like bearish, you're not alone. Hundreds of thousands of people's out there recorded in our sentiments show that they're very bearish at this point, 39%, and bullish, not so much, almost 30%, which we haven't seen since start of this year. We have been always hovering about 30%. So definitely a sentiment change. Instead of being negative, instead of being positive, people are getting more negative. At least in this point in time, generally in terms of the trends. So I guess on to our last segment, Wowie, you have a quote of the week?
Oh, so my quote for the week is, a wise person should have money in their head and not in their heart.
Oh.
So you have to think about your financial situation.
Right.
You got to learn how to budget, weigh your risk. What exposures do you have as far as debt and stuff,
right?
And try to stick with the budget. Some people can drill down their expenses to the last cent. I'm not like that, but if you can do that, I mean, if you can do that, then that's a highly perfected budget.
I think I think that really makes sense, Wowie. Now that I thought about it, mind in the head rather than heart, because like as my experience recently, I almost bought a house Like a newly built house is very expensive. I've been doing my research for all this time trying to look for another property, but I almost provided like signed the documents. I actually signed the documents, and it's only up to me to continue if we're gonna do the inspection and all that. But I thought about it, and just one morning I woke up and thought like something struck me and it didn't feel right. So I think I was just overpaying for this property just because it's newly built, porcelain tiles, open floor concept, tall ceilings, 13-foot ceilings. But in the end, it doesn't make sense. So I just pulled my offer. And if I'd rather have the money in my heart and thinking that, oh, I deserve this, so I would have ended up entrapping myself with a newly built house overpriced at this point, in my opinion. So I think it's always good to run simple calculation if your income would be able to cover it. If it doesn't, or it will entail that you would need to work even harder after that, then you're not making a good decision right there.
That's a good point, Mark. And for our listeners out there, your ratio when it comes to your mortgage payment should be about 28% of your cash equivalent.
Your income.
So your income. So yeah, so just kind of make sure that you don't go over that ratio, because that can cause some issues.
Right. I agree with that. And well, Wawi, thank you so much for coming on. Listeners, that does it for this episode of Mark Yu and Wawi Show. Send your questions to email markyuwawishow@gmail.com. Remember, build that emergency savings and invest the rest for an abundant retirement. Again, this is Mark Yu signing out.
And Wawi Santos signing out.